Okay. So the recording is I've started the recording, and like like I said, uh, we'll if you have during the presentation, if you have any questions after the presentation, if you have any questions, keep putting them in the chat box, and we'll come to them. Uh, so let's get started. I don't think we will. Let's not waste any more time. Let's start. Screen share. I Do let me know if you are not able to see my screen, but I'm on full screen. How will I know if you let me know? See if I can. So, settings. So, yeah, okay. So if my screen is visible, let's go forward. Once in a while, I might have to toggle back to admit people because I'm doing these things. So first of all, disclaimer: any disclaimer says the same thing. So basically, says that you're not supposed to listen to what I am saying. You are supposed to do your own due diligence, etc., etc. So here we are. This is what the world is looking like right now. Right. So you have continuously every day, every week, something new popping up, mostly negative, and I'll come to that a little bit later. You have Mr. Trump tweeting something pretty much every day. Elon Musk love-hate relationship. Uh, as of now, I don't know whether it is love or hate with Trump, but I'm guessing that neither does Elon Musk know, nor does Donald Trump. That's the way it has been. Uh, Russia Ukraine continues unabated. You have Israel Palestine. You have Israel Iran. You have US Iran. We've had Operation Sindoor, India Pakistan. We've had so a large part of our consciousness is now focused on what is going on around us, and the news flow is significant in terms of uh, negative news, right? And we all are sucked into the negativity of the world, and when that happens, just so there are two or you know a few psychological biases that completely take over our minds. First and foremost is recency. So whatever that has happened recently uh, is fed into our minds by media, whether it is traditional media, whether it's social media, whether it is WhatsApp forwards. It is what is happening. Aaj ka taza khabar is the breaking news syndrome is what sort of completely captivates and captures our mind. The second thing that happens is that news uh, is, if it is more vivid, if it is emotionally charged, if it is extremely engaging visually, right? A lot of imagery. So what we saw during, say, the wars that is going on during Operation Sindoor. So the same kinds of images are thrown at you, no matter where you look. today I think uh, I would say that more people are influenced by social media and WhatsApp than traditional media. And it's a very uh, powerful medium because it is there always with you. So when we were growing up, people who are 40, 45 and above, uh, when we were growing up, the only mode of visual sort of video images was the Doordarshan news. It used to come, pretty much 2 or 3 times a day. That's it, in the evening. So, English news 9:30 in the night, and regional news I think 7:30 or 7 o'clock, whatever it was, and then Hindi news at 8:30, 8:35. That was it, right? And that was your source of information. Prannoy Roy became famous because he used to do once a week show called The World This Week, right? So imagine the pace of news, uh, you know, being thrown at an individual, or and in our case as an investor. Once a week show World This Week versus you know news flow every second through Twitter, through YouTube, through WhatsApp, through Instagram. And all of this is, sort of compounded by the problem of negativity. How many of you remember any positive news in the last news cycle? You would have to really rack your brains to think about anything good that is being written about events, people, anything. Even, when we win if we lose a cricket match, it is not uh, how well our players have played or how well our opponents have played. It is always negativity about either the coach or the manager or the captain or the bowling team or somebody who's dropped catches, etc. So why is that? Because again, human tendency over eons of history is that we give higher uh, weightage to negative news. Our mind is attracted to negativity, right? Because uh, in the hunter-gatherer days, if you did not, if you ignored negative news, you could probably be food for some uh, large beast. And all of this put together is the phenomenon which is coined by Charlie Munger. My sort of in Bengali we call him Bhav Guru. Somebody who I've learned a lot from. Somebody who, more than investing, I think you learn how to live life, how to think rationally from Munger. Is the Lollapalooza effect. And Lollapalooza effect is not that when multiple biases work against you, they are not additive in nature. They are not 1 + 1 + 1, right? These recency, vividness, negativity, all are working together, and they have a very disproportionate irrational outcome. They have a multiplicative interaction with your thoughts, right? So suddenly you find your mind attracting other negative. The market is falling, gold is going up, will the world come to an end, and so on and so forth. Now, will we have a nuclear war? So these are the kind of things that we continuously think about. And once you sort of think about it, and you understand that the mind is tricking you because it is overweighting the negativity in the short term, you take a look at the Nifty 500 index over the last 25, 26 years. And you see that there has been very big falls. Here, in 2000, Nifty 500 fell 70%. 2004, it fell 35%. 2006, and this is, mind you, during the bull market of the 2004 to 2008, just in the middle of that, 33.5%. Then you have the global financial crisis, nearly 70% once more. 2010, 33%. 2015-16 period, 23-24%. COVID, 40%. 2022, again, 21%. And now, in the last 7-8 months, we've had another 20%. So the point I'm trying to make is that in this entire journey of 25, 26, 30 years, the market has gone down a lot, a number of times. But even with that, if you have, say, a 5, 7, 10, 15, 20 year kind of a horizon, which is what I think is a minimum as an investor, right? Then you see the trajectory, right? Even if you've bought at the peak of 2000, right? The market was what? I can't see here very clearly, but maybe around 1200 to 1500. And where is it today? Nearly, 23,000. So point here is that ultimately, what is the market? The market is a group of businesses, which is where the stocks are getting traded. If an economy does well, if people continue to consume goods and services, businesses will thrive. And if businesses thrive, markets tend to do well. The only caveat to that is we should not have had very large excesses in a very short period of time. And even, so a lot of cases in point, and I'll again come to some of them in this presentation. So Japan, whenever we talk about, markets not doing anything, the classic example is Japan. Everybody wants to talk about, how Japanese market did not do anything for 30 years. And that is right. The Japanese market did not do anything for 30 years because the previous 10 years, it sort of went completely berserk. So the froth that got created, it took that amount of time to clear that froth. And even within, in those 30 years, there would have been some companies which could have done. So with that background, again, let me come back to what is actually happening. Forget about the wars and the negativity and what is being thrown at us today. Across the world, we are one of the better performing, if not one of the best performing economies across the board. And IMF is acknowledging it, the world now acknowledges. And this is going to continue at least for the next 20-25 years because the demographic is supportive of in the India consumption growth story. While all these wars and negativity was going around, India slowly keeps moving up the ladder in terms of the large size of the economy. Again, the critique, a lot of people immediately ask a question, saying that our per capita income is so low. So how does it matter if we are number 2, number 3, number 5, 7? See, the point is that in the short term, we really can't do anything with per capita simply because the denominator is there. It is the number of people that is there. We cannot wish them away. We cannot say that, if the denominator will tomorrow suddenly become half. We have 140 crore people. One fine morning, it is not going to go down to 50. If it went down to 50, our per capita would jump 2.5, 3 times. right? But that is not going to happen because the denominator, to shift the denominator downwards, it takes decades. And if you see the demographic or the fertility rate, replacement rate in India, it is already now at an aggregate level, at least in a large number of states, it is below the replacement rate. So it is below 2.1. The replacement of 2.1 is basically because when two people have a child, they are not so two father and a mother having one child means that after a few years, when the father and mother passes away, the population goes from 2 to 1. So basically, to have the same number of people, you need to have two people replacing two people, right? So ideally, it is two, but statistically, it has been found that it is 2.1 because there is child mortality. People quickly, but people sometimes die of accidents, early deaths, etc., etc. So 2.1 is the replacement rate of population globally, and India is already in a large number of states below that. Now there are negative connotations also to a reducing number of people, which is that over a period of time, what will happen, and these are the problems that we are seeing today in Japan, in large parts of Western Europe, is that the number of working people is significantly lower than the number of non-working people, basically the old pensioners and the very young who are not yet in the workforce. So basically, you have a very small number of people who are working to support a larger number of the very young and the old. And that is again not a sustainable system. So we'll not get into the details of that. The fact is that the denominator cannot be wished away or changed very quickly. The only thing that India as a country and we as people can work on is to increase the numerator, which is the actual GDP. And that is where I think India has been doing reasonably well. Can we do better? Obviously, in everything we can do better, right? This is not a school exam where 100 marks is the maximum, and you cannot get 101. This is a field where you can keep improving yourselves and doing better and better. In fact, a lot of economists suggest that India should be trying to grow in double digits, because otherwise it is going to be very difficult to sustain the overall. Now, let's look at the emerging markets. And across the emerging markets, I think India is probably having one of the best all-round macroeconomic numbers, whether it is GDP growth, whether it is manufacturing, exports, inflation, exchange rate stability, etc., etc. So again, net, we are very, very well poised. We are doing well, right? So don't have a negative mindset towards our, the Indian economy or the way the markets are, or in Indian economy and the way the markets are. The markets will be volatile. That is the nature of the markets, and that is fine. We'll have to take it, in our stride. The other, this slide is very important because it shows us that the market cap and the profit after tax both continue to go up, and the trajectory of growth is, over. Again, these are longer time slices. We are not looking at quarter to quarter. We are not looking at very short duration. We are looking at longer term trends. We are looking at 3-year, 5-year, 10-year trends, and you see that the market cap and the PAT both are going in a direction that is desirable for us. Now, this is a slide which I think is very important, and I think this is where the next shift is going to happen. So if you see, pretty much from 1990 to 93, 94, we had Emerging markets outperformed the US significantly. Then we had a phase of 5-6 years when the US did fantastically well because of the dot-com boom. Then we had the dot-com bust, and slowly over the next uh, 10 years, right, you had the emerging markets do fantastically well. So emerging markets, India, China, that was a time when we were hearing of BRICS, going to beat the world, etc., etc. Then 2010 to now, we have seen the domination of the US primarily led by the tech stocks, tech, now AI. So that has been what is driving the US resurgence. And somewhere, I think that is now coming to an end. It has been sort of accelerated by the political dispensation there, because they want the US situation is that debt, national debt, which is unsustainable. The government wants to bring down debt. They want to increase employment, etc. And so you have policies, you have a government which is trying to force that, and literally forcefully trying to do that. And obviously, these will have repercussions. Uh, I think the confidence that the globe, the world had in US is pretty much in the lowest in the last maybe 100 years. Nobody wants to. Nobody trusts the US government in terms of having a stable policy dispensation right now. So that's where we are, and I think there is a very distinct possibility. In fact, if I look at the FII numbers, and if I look at the capital flowing back into emerging markets, I think this move has already started, where money starts moving out of US into Europe, into other asset classes like gold, silver, platinum, etc., and also into emerging markets. Uh, I think I have another couple of slides, and these slides are very, very interesting. Is we have multiple strategies that we involve, sort of use. Uh, and I personally am a very, very big supporter. If you've been, with me for a while, you would always know that I keep suggesting that we should invest in multi strategies. It's immaterial whether we look at multiple market caps. I think the entire mutual fund industry uh, is working on a market cap split basis. So you have this focus on large cap, mid cap, small cap, etc., etc., multi cap, flexi cap, all cap, no cap. But I think what is really more important is to have multiple strategies. So you can have momentum, you can have growth, you can have value, you can have quality, you can have combinations of these, etc., etc. There are many different kinds of strategies, and the more different types of strategies that you have in your asset allocation, the smoother your equity curve is going to be. What that means is the smoother your journey will be. Historically, momentum has given the greatest returns over long periods of time, but growth, value, low volatility, quality, all have their own ways to play. So, for example, in the last 6 months, if you see, quality has done reasonably well, low vol has done well, value has done well, and if you look at all the momentum indices, all the momentum indices are down, right? And in the last 6 months, if you see, you might ask this question that Why is that? Because the market is now back nearly to its all-time highs or very close to it. Why is it that these momentum uh, uh, portfolios are not doing well? The momentum portfolios are not doing well because the market is not yet uh, unidirectionally trending. Momentum works fantastically when the market is trending one way, and which is like 75% of the time, right? Three-fourths of the time the market is trending, and that is when momentum does really, really well. And the money that you have not made or you've lost during the other one-fourth of the time is actually made up during the other three-fourths of the time. But during that one-fourth of the time, momentum will not do well because the market will be choppy, will go up, go down, there will be sector rotation, etc. Right? So that is why you will find that the momentum indices are not done. And this is the same, chart, and I've given the link. This is a very interesting. I mean, from Edelweiss Mutual Fund, they've sort of given this site where you can play around with different types of factors. And I've taken the 10-year view here. And if you see across board, right, say the Nifty mid cap momentum here, which is 22.7%, and small cap momentum 19.6%, multi cap momentum 18.5%, Nifty 500 momentum nearly 19.5%. So you will see that over the last 10-year period, momentum has pretty much outperformed, whether it is quality, low vol, equal weight, value, pretty much everything. So again, what is the takeaway from these two slides? The takeaway is that at different points in time, different strategies work. If you are invested in a strategy, first of all, you should be invested across board, across multiple strategies. And that is why, we have different types of, different types of advisories. You have different, two different funds in the PMS that I run. Is simply because we want to capture the different strategy factors. So next two slides is very important. What are we doing differently? What did I learn from this fall? So first thing that I personally learned is that I should not overwrite my own, processes. And that you have to read along with the second, line together, which is, our portfolios held on pretty well. I mean, the market started falling roughly from September last year. I think the most of our stocks did well till I think about end of December, end of January, and the market was falling. Our stocks were doing well, and I was really feeling very happy. That Nawazuddin meme continues to keep in mind ki apuni bhagwan hai types. And that is a very dangerous feeling in the markets, because that when you start getting these kinds of feelings, it sort of means that there is something which is where maybe the top is getting very near, or conversely, if you're really getting the other Nawazuddin meme, which is "Roz subah utho na pito so jao," then it means that the bottom is also very. So I think first and foremost, I think should not override the processes. It's always, I keep saying this, but need to do much better doing that. The good part is this is not the last fall that we've seen. This kind of fall, I will sort of guarantee that we will have in another 3 years, or with the cycles now getting shorter and shorter, maybe in the next 2.5 years, 3 years, who knows. But if I am going to be investing for, say, the next 20-25 years, probably we'll get to see another 8-10 such falls, and hopefully next time I'll be doing better than what I did this time. The other very important learning for me, or not, I don't know whether to call it learning, but more of realization, is trying to save capital gains taxes is a fool's errand. The last budget, not this one, not the current budget, the previous one, we got our capital gains was increased, and I was trying to sort of uh, hold on slightly longer, ignoring my uh, sell signals, because I thought, like ज़्यादा capital gains लग जाएगा तो थोड़ा सा wait करते हैं. Market is choppy, it will go back up, etc. etc. So I think that's a very bad idea. If we get sell signals, I think the least we can do is to act on it. And last, I think 6 months since we spoke, I've been doing a lot more work on using data, using data-driven insights. So that is something, again, I am sort of banking much more on going forward. So you'll see more data-driven insights, data-driven action in the stock picking, in the processes that we follow over time. And in all this, what should you do, right? So obviously, first thing you should do is, always, when in doubt, go back to first principles. Remind yourself, why have you started investing? What are your objectives? What are your long-term objectives? I'm sure most of you, at least people who read my stuff or associate with me, they're not here for doing day trading. You may be doing very short-term or short-term trading for the fun of it, but that is not your primary lookout. So be clear as to why you are investing. And most of us, we are investing for long-term objectives. So it's important for us to realize that the nature of the markets is that it is going to be volatile, not yesterday, not today, tomorrow. It will always be volatile. There will always be good news, there will always be bad news. Never invest money that you need in the next 2 to 3 years in equities. Keep it aside. You never know what will happen in the markets. Markets can be exuberant, markets can just collapse. And why I say 3 years is because typically in 2 to 3 years, nowadays we are getting a cycle in 2 to 3 years. So typically, even if you get the worst of it, 3 years is a decent time for you to get out of a bad market cycle. So don't invest in money that maybe you need for whatever. It could be your child's education, it could be children's marriage, it could be health requirements, taking that dream travel, etc., etc. Don't use that money for don't put it in equities. Put in fixed income, put it in, I would say always put it in fixed income. Do not panic in bad times or get overly enthusiastic in good times. When the markets is very good, don't get overexcited, don't get exuberant. When the markets were doing really well, in every interaction that we had, in every newsletter that I write, I keep writing about the 1 in 4 rule, right? Which means that 1 in 4 years you're going to lose money. 1 in 4 stocks that you buy, you will make a mistake, and so on and so forth. So point is that in both extremes, don't get swept away in either excitement or in despair. Always very good to have a regular savings and investing habit. Do your SIPs. I prefer doing SIPs in my own stock portfolio, not in mutual funds. Do not leverage your portfolio. Don't borrow and put money. And the last point, I think we are at the cusp of a very good next year and a half. Markets will remain volatile, but I think we are headed. And in fact, I think in April sometime, I did write a mail or a blog saying that we are probably we've sort of made the bottom and things are going to get better from here. And the markets have inched up seriously from there. But I think that's just the beginning. I think we are headed for much, much higher levels in the market. I would not like to hazard a number to it, but I think we are in very good times. We are, I'm personally hopeful that we are heading towards very good times in the next year and a half. So you might want to allocate a bit more of your savings to equities per se. With that, I think I'll close my part and let me stop presenting and get back. Okay. So let's scroll down and see the questions. Anand says, yes, sir, it was promised at least quarterly. Yes, Anand, I know, and I know I screwed up as well. So feel free to, I mean, if you, so this is June end, July, August, September. So if you don't get an invite from me by end of September, please, let me put the ball in all of your court. Feel free to send me a mail saying that you promised a webinar and you're not doing it. So I'll probably then do something. But I'll definitely try and do this more frequently. Next question is from Shashi Kapoor. Wow, one of my favorite actors. Not you, I mean the original Shashi Kapoor. How to get into a moving train stocks like Frontier Spring, Axis case, where you know that earnings are rising and will be good, but the movement in price has been fast. Okay, so I'll not get into specific stock names, but I will tell you the general principle of it. Okay? So whenever you have a stock where you have this inclination that the earnings are going to be good and you want to sort of participate, but the stock has run up, there are only two things you can do. One is you wait for a pullback to happen. And the second thing is you take a very small, so assume that you want to take, let's say, a 5% position of your portfolio. So let's say your portfolio is 100 rupees and you want 5 rupees. So what you ideally can do is you take 1 rupee position and wait for a pullback. Because if you wait initially, you don't know when the pullback will come. So today, if the price is 100, it can go from here to 110 and retrace back to 105, and you'll still be, then under that mental, price anchoring bias कि अरे मैंने में देखा था, तो अभी तुम 100 रुपए में नहीं लिया, अभी 105 में कैसे? Right? So you will get into that trap. So the best way to do is you buy a very small allocation. So अगर 5 रुपए का लेना है, so you buy 1 rupee at the current price, and then just keep slowly adding. If the price is going up, every addition, your cost price will be lower than the market price. So that is the way you can slowly scale up. And you might want to just sort of have some kind of a trailing stop in these kinds of very fast movers, because typically what tends to happen is a lot of these parabolic moves also retrace very fast, right? And a lot of times the retail investor ultimately, when they enter because of FOMO, they will actually enter either at the top or very close to the top. So if you are doing that, but you are very convinced that the future is going to look good, then you might want to have a deeper stop loss. You want to give it 25, 30, 35, 40%. If you are not willing to do that, then the other staggered approach of buying is what you might want. Okay. Another question from Shashi. Also, how to allocate to a stock where we know that results will not be good for a year, like it happened in HPL. However, long-term future is intact. How to vary the portfolio allocation in both scenarios for high growth and good. So this is like using a graphic equalizer. Abhi to I don't know if, today's all digital music systems don't have it, but when we were young, we used to have these stereo systems, and uske samne bahar, we used to have these graphic equalizers. So 5, 6, whatever, depending on how good the systems were, between 3 to 5 or 7 graphic equalizers where you could take up the slider up and down. So pretty much you have to do the same thing. The only caveat is mostly it is very difficult to, right? Because once you reduce your allocation, there is an element of timing that you will need to do to increase allocations once more. So you'll have to be very, very actively engaged. Okay, HBL or XYZ, I have to reduce. ABC, I have to increase. Same time, maybe stock Y, I will reduce. Stock M, I will increase. So you have to continuously do that. Instead of that, if you have a, say 2 to 3 year horizon, and you know that the stock is going to do well, just keep quiet and have a balanced allocation and sit tight. Right? Sometimes, because also I have seen what happens is markets always don't listen to the earnings projections in the short term. What I mean by that is, हमको ऐसा लग सकता है कि next year earnings will be low, but there may be a lot of buying interest anticipating the earnings for the following year, and the stock price goes up. Right? So there is not going to be a one-to-one correlation with earnings and stock price in the very short term. Right? So I hope I'm able to explain what I'm saying. So it's sometimes as a long-term investor, it is better to let things be and allow it to play out. People who are more clued into the market, who want to do these things, they can sort of try and time in entry, exits, reductions, increase, etc. Sometimes it is worth the trouble. A lot of times it is not worth it. The next question, I don't know whether it's a question or a comment from Sunny Kumar. Repo rate reduction. I don't know what that means. Repo rate, I'm assuming you meant repo rate reduction. Yeah, so repo rate reduction would mean that interest rates would go down. Interest rates are on the way down structurally. I think it's been down more than 1% since it peaked out. And I think inflation in India is headed way lower. This time, I think monsoons are, at least the initial phase of the monsoon is being good. Food and crude, what I say is what impacts inflation in India. And both have been subdued. So hopefully things will be good for us. Abhishek Deshmukh, no positive news, sir. It's only I can hear from long-term investors only like you. I think that's not true. I think the reason why you don't get positive news is that nobody is focused on positive news. There was this experiment that I read about that was done in a British, I forgot whether it is British or Scottish newspaper, where the editor got fed up, and this happened in I think the last 5-6 years. The editor got fed up and he said that we will only publish good news from now, and this is just crazy. The world is going to the dogs, and we will not publish all negative news from now. And he started publishing all positive news in his newspaper. And within a month, the circulation dropped, and he had to revert back, because the nature of people is that we get captivated with negative news. And so that has now become a spiral, that you like negative news, I feed you negative news, I scare you. The more I scare you, the more you get scared, the more you listen to me. The more you listen to me, the more newspapers or magazines or whatever I can sell, and my TRP goes up. Right? How many of you watch DD News, Doordarshan News? I can bet that it is probably going to be less than 1%. Try it. If you want to watch news, just open DD News and maybe the 9:30 the night news. Just watch 30 minutes of that news. Trust me. Even today, they are doing the same news broadcasting that used to happen 30 years back. No hyperbole, nobody screaming at people, no studio debates of people who have come with an agenda, etc. So it's not that we have, there are no positive news. It is that the focus of the media, the focus of people is that we are attracted by negative. The next question is from, I don't know how to pronounce, HLSBAS. If investable capital is 100%, what is your style for capital allocation between three pockets, cash, gold, and equity? That's not a very good question to ask to me, because my style is 100% equity. I don't believe in gold. I don't believe in anything else. I believe that the only way to create wealth is by being a business owner. If you cannot run your own business, you can be a silent partner in somebody else's business. I feel very happy when I see people like Mukesh Ambani and Anand Mahindra and Gautam Adani and whatnot. I mean, all the big promoters getting up in the morning, going to work, and I have one share in their company. So I believe that they are getting up in the morning and working for me, right? So that is the mindset I think all of us, especially people in the younger generation, need to inculcate. Gold, etc., is an asset class which is primarily used as a hedge. Gold will do well in very uncertain times, and then it will go for years, sometimes decades, without doing anything. It does not compensate you for holding it. It doesn't give you a dividend. If I hold a stock which pays dividends, at least kuch nahi to 0.51% dividend yield I will get, right? If I buy good dividend yield stocks and make a separate basket of it as a passive portfolio, I can buy stocks with 2.5% dividend yields and make a basket of it and keep. So to me, it's a no-brainer. Anybody, I think, people who are young, I think it should be a no-brainer. They should have money invested only in equities. If you have a lot of liabilities, then you might want to, have equities and fixed income. I don't write away fixed income because fixed income is sometimes required to give stability to your portfolio. Not everybody is, in the same financial situation, family situation, or not everybody has the same risk-taking ability. So if you want to keep it very simple, just go with fixed income and equities, and keep it simple. Do it over decades, and I think that's the best thing you can. Anant Patel, do you foresee opportunities arising to deploy existing cash portion in the long-term equity portfolio? Definitely. Like I said in the last line of my presentation, we will be, my guess is we are heading for very good next 12 to 18 months, maybe next 2 years. And we will be getting fully deployed. Been working a lot on a number of stocks. And so you'll see a lot more happening in the near future in that. The next is from Ritin. I have a question regarding deploying the money in the recommended stocks. As someone in a private sector job, cash flow is monthly, and as you say, don't deploy the money in one go, invest in tranches. I also intuitively believe the same, but the problem comes when the stock ferociously goes up while the allocation is still full. How does one handle such scenario? This is the happy situation when the stock is going up and allocation is full. The two ways you can, so basically, if I understood your question, the problem is that you are getting a monthly salary, you have savings, what to do with it. So the best thing to do is have a very disciplined approach. If you have enough savings to deploy uh, across all the stocks in the portfolio, then go ahead and do that. If not, just pick maybe the top five in 1 month, the next five in the next month, the following five in the third month, etc., etc. Pick any algorithm or pick stocks where the allocation is lower than optimum, and you don't have to be like decimal point correct. You have to be in the broad range. If some stock needs to be 5%, if it's 4%, 6%, it's okay. It should not become like 2% or 10%, something like that. As long as it's in the ballpark region, I think it's good, right? Uh, Basically, try to be deployed in the stocks in the portfolio. I think that is the more important part. Uh, you can figure out any simple method that works for you. You could see that, okay, whichever stock has not moved, whichever stock has moved the least in the last 1 month, I will put money in those, and so on and so forth, right? So you could actually do it that way. Next question is from Abhishek Deshmukh. Sir, even though net FPI is negative and it's certainly uncertain to even forecast, do you really think that it would affect Indian markets in the long term? I think, see, FII flows have been very strong in the last 2 to 3 months. FII, FPI, etc. flows have been very, very strong. DII flows are strong. See, my personal take is, and again, I've explained this before, market price is determined by two things. One is, so we all know the formula, right? Price is equal to EPS into P. The other way of looking at it is price is equal to EPS is nothing but your intrinsic value, and your P is nothing but liquidity. So the price of a stock or a price of a market is determined by the intrinsic value and the liquidity combination. So obviously, if liquidity flows improve, one of the reasons why we have seen such a sustained rally from the COVID lows is that the retail liquidity flow in India has been super strong, right? And my guess is that retail flows is going to be stable and consistent for the next many years, because a lot of people who are now joining the market are young people who have understood the power of equities. And I think that is very, very important, right? So liquidity is very important, whether it is FIIs, FPIs, DIIs, etc. It does impact markets. It does impact sentiment. So we should always keep an eye out on it. But it is not the primary focus. The primary focus is the overall performance of the businesses and the overall performance of the economy. Because once those two are in place, the third will follow. Abhishek, one more question and one more. Any one sector which will surely boom or good growth in coming years? I think not one. Let me talk about a few sectors. The first thing is, I think manufacturing in India is picking up, and it will pick up because there is a lot of focus. I think there is a lot of government spending happening in sectors which require the underlying manufacturing to happen. So defense, both internal consumption as well as exports have picked up significantly. And that is going to pick up much, much more, right? So once defense picks up, defense requires a lot of manufacturing. Capital goods, roads, railways, ports, etc. So all of this requires a significant amount of manufacturing development. So I think manufacturing is one place where it will do well. I think discretionary consumption is going to do extremely well. I think interest rates going down short to medium term. I think banking, financials is likely to do extremely well. I think chemicals in pockets will do extremely well. Pharma, CDMO, CRAMS, that entire space, I think it's going to do well. What did I miss? I think power sector, power ancillaries, again, lot of work happening. So that's another space. In the emerging themes, I think we should be looking at plays related to or subsidiaries of nuclear power, related to travel, related to aviation, airlines, airlines maintenance, airline supplies, all of that. Defense obviously is a very big theme. I think short term, maybe it's sort of a bit frothy, but medium to long term looks fantastic. I think overall, I think a lot of sectors likely to do well in the short to. Oh, now another one I missed, cement. I think cement is going to looks very, very interesting. It can pick up significantly. Last 10 years, I think cement has done nothing. And across board, there has been price inflation in all building materials excepting cement. So my expectation is that cement has been in that 350 to 400 rupees per bag. I think for the last 10-15 years, we could see a 10% jump in prices, 10-20%. It could go to 480, 500 plus. And if that happens, and there has been a lot of consolidation in the sector, so cement can do well. So I mean, pretty much a lot of areas where I think India is going to do really, really well. A lot of sectors are going to do well. The next question is from Ekta. Hi, I'm a new member in the long-term equity membership and would appreciate if you could guide me as to how should start investing in the list and make my portfolio. Okay, so first of all, Ekta, thanks for thanks and welcome into the IntelSense family. The first thing to do is look at the stocks that are there in the portfolio and replicate that as is, right? Don't look at the current price, don't look at the recommendation price, don't look at when it was recommended, etc., etc. Just take a spreadsheet, write down the stocks, write down how much money you want to put in another column, just divide the current price and get the number of shares you want to buy. So let's say you have stock X and you want to buy, say, 100 shares of that. Buy 20 this week, and then buy another 20 the following week, the week after, and week after, and over the next 4, 5, 6 weeks, you can, in a disciplined, staggered manner, buy all the stocks. So that's the first step. That's the first step of replicating the portfolio. The next step is just blindly, not blindly, follow the guidance that we keep providing from time to time about buying and selling. So if at some point in time, so let's say you've bought a stock that is there in the portfolio and you had to buy 100 shares and you only ended up buying 60 shares after 3 weeks, and you are waiting to buy the remainder 40, and you get a sell recommendation and saying that, okay, you sell this and buy something else. Uh, don't get into that mental trap of thinking that, "Arey, I just bought this now, let me hold on and do all of that." Uh, just sell those and buy the new one. It's as simple as that. Initial first few months, it will be slightly, uh, you know, there might be some amount of churn, but ultimately, over say 6 months, 1 year, and more, you will your model portfolio will start replicating exactly what we are doing, and that's the way then you start, sort of getting the major benefits. Next question is from Ramnath. Sir, what relevance PE has in today's times? Should we take a broad approach looking at a market cap? Today, everything looks expensive based on conventional. So, first of all, I have never been a very big proponent of PE. I think PE has a inbuilt, uh, PE as a valuation metric is not a very good idea. I have always sort of thought that PE incorporates the valuation of a stock and the liquidity, the expectation, the narrative building, all of it in one place, right? So, just buying low P, buying high P, to me is nonsensical. So I don't honestly give much credence to PE. I look at the core business. If I'm doing my fundamental investing, I'm looking at the core business. I'm looking at the growth prospects. I'm looking at roughly how much I'm paying for it, etc. Uh, and then we are looking at the quant side, the technical side of it, and seeing, whether this is a good time to enter, whether this is a good time to exit, and things like that. So that is how we try to do our stuff. Uh, we should not be looking at P as a valuation metric to buy and sell stocks. Darshan, thank you for your wonderful insights. You feel market is poised to do well over the next 12 to 18 months. However, US debt is ballooned and may be vulnerable to chances of slowing down major correction from the mother market. So I do not believe that US is the mother market. All this is absolute, meaningless talk, fed by social media and Twitter and etc. I did show you a chart which showed very clearly uh, many years where US underperformed the emerging markets. So anybody who talks about US doing badly and that reflecting in the world absolutely does not know history, and then the discussion stops there. There's no point in discussing that any further. The next question is from Ritin. I was going through some YouTube videos of Ray Dalio where he's talking about changing world order and how empires rise and fall. Do you think we are in that phase where we will see the fall of US imperialism? How much time have we got? This itself will take a couple of hours if we discuss this, but Ritin will come back to this. I'll try and answer this from whatever I have thought about. Let me go back. Let me go and discuss about the not so bigger picture question. What is your view on water theme sector and why are we not adding any name in the portfolio? I think water also will do well, like in any other themes or industries. Why we are not adding any name in the portfolio is so adding stocks in the portfolio is like selecting the Indian cricket team, right? So you have 50 great players playing IPL, 50 or more, but you only have 11 players, 11 slots in the team, and you can have maybe 5, 6, 7 results, right? So your job is to pick one wicket keeper, 4 or 5 bowlers and 5 batsmen and constitute the team. So it is always going to be a question of relative choice. And that is how I have always thought about portfolio construction. It is always when you are saying some yes to something, you're saying no to something else. And when you're what you are saying no to, sometimes can do better than what you're saying yes to, sometimes will do worse than what you're saying yes to. And that is why investing is such interesting endeavor. It is also why you feel that investing is probabilistic, because you don't know, right? You pick a player thinking that he will do well and then he flops. So like I like to give this analogy that you will have a choice of class players and you will also have a choice of informed players. As a selector, your job is to look for class players who are informed. In the market, that will correlate to you want good fundamental companies who are technically strong, right? So that is what you are trying to look for. Okay. In that process, some names will fall out, even though they might do well, right? So in the Indian cricket team, aren't there players who are sitting out who are very, very promising and will do well in the future? Of course, there is. Similarly, that is the case for any portfolio as well. Especially for people like us who like to run concentrated portfolios. Otherwise, it will end up looking like a Nifty 50 portfolio where you have 40, 50, 100 stocks, and it is meaningless, right? We are not a mutual fund where we hold 100 stocks with 1-2% allocations, none of which will make a difference to our lives. The next question is from Rajarshi. Is the liquidity factor the main reason for the rise in Indian markets, as the cost of capital is going down and more rate cuts should follow? So, if you do a DCF, I think cost of capital is a very important factor. And when rates go down, typically equity valuations tend to go up, and also, a lot more money flows from fixed income markets to equities. But I would I say that is the main reason why markets are rising? I don't think so. I mean, ultimately, I think people slowly, I mean, even today, if you look at the under penetration of equities in households, it is abysmal, right? Uh, we are at the cusp, or we have just started as a country investing in equities, whether it is through mutual funds, whether it is direct, whether it is through insurance, etc., etc. But the point is that ultimately, over a very long period of time, you want uh, more and more people participating in equity markets, not for the market's sake, for their sake, right? Because end of the day, the money, the wealth creation happens in equities, and that is unsurpassed by anything else that you can see. Sandeep Sharma, your question is, any views on the CDMO sector in India? I think very positive. A lot of these companies are doing very good work. What else? I mean, you have to make your choices. In like in any other sector, some companies will do better than the others. But yes, I mean, overall the sector looks extremely promising. The next question is from Grande Sivakumar. Where to see the PMS returns? You can drop us a mail and we can send you the latest fact sheets, etc. You can drop us a mail at equity@intelsense.in or equity@srirama.co.in. Sandeep Banerjee, is there any listed semiconductor stock in India? Not semiconductor, but there are companies which are directly, indirectly in that ecosystem. Tata Technologies does some work. There's some, small electronics companies, but no, really major player that is listed. The next point from again HLS Bas is, The tax generated by the government has been little low so far this year. How does this reflect the corporate profits being a little low? How this gel with the fact that we should be optimistic of the future 6 to 18 months? Uh, so corporate profits, uh, I think now is not, the time, this is just the first quarter, right? So corporate profits will come in later. So I not really understood your question, but profits for the next period is going to come, we'll come to know of it a year later. What profits you are seeing today is a reflection of how the companies did in the last 1 year or last year and a half. The next point is from Arvind. If all past big falls have been recovered, why do you have a tendency to sell 20-25% in bear markets? Okay, so very good question. I think, see, the problem is why do you, your question essentially is why do we sell 20-25% in bear markets? So the reason we do that is because around that 20-25%, 30%, you don't know whether this is that time when it will go to that 50-60%. Right? I showed you that chart, in the beginning where we saw the markets correcting 70% in 2000. It corrected nearly 70% again after the global financial crisis, right? COVID, it corrected around 40%. So the point is you're trying to protect yourself from catastrophic loss, right? That is the reason you go partially into cash. And if you see that we try to get back in quickly as well, not always, with the entire capital, because I believe that in the longer scheme of things, our journey is for wealth creation, right? And one part of wealth creation is we have to play the odds at in the real time. So today it is very easy to sit back and say that market to 20-25% gira, then why did we not buy, or why did we sell, etc. But the point is, at that time you are never sure whether it is going to fall significantly further. The other thing is, if you do back testing with data on stop loss based systems, you will realize that any stop loss based system is actually over the long period of time going to reduce your returns. Let me repeat what I just said. Any stop loss based system is going to reduce your overall returns. Contrary to what we think that, stop loss is going to protect my capital and lower my drawdowns and hence increase my returns, it is actually the opposite. It is going to overall reduce your returns. So why does it reduce your returns? It is precisely because of this, because what happens is when the market goes up, it falls, your stop loss gets triggered, it falls maybe a little bit more, and then it rises, right? And you are not getting back in at the point when you got out. You are most of the time, 99% or 100% of the times, you are buying back in after the point which you sold. So if you had held on, if you had just gone to sleep, not looked at the markets, if you had just held on, then your stop loss would not have got hit and you would have just held on. So that drop would have been notional. When your stop loss is getting hit, you are actually taking your loss and then you are buying back at a higher price. So overall, over a period of time, stop losses will reduce returns. But then why do we do it? The reason why we do it is twofold. One is it gives you staying power in the market. It gives you emotional staying power that I have some cushion. I want to remain in the market. You don't never want to get out. You don't know. Even at a stock level, I have seen stocks falling 90-95%. Right? You never want to be in that situation because from there is no recovery. So at somewhere between 10 to 30%, depending on your time frame, depending on your confidence, depending on your conviction, is where you have your stop loss, and you step back and say, no, this is a mistake. Let me wait it out and then get back in later. The next question is from, again, HLS. How do you see power transmission InvIT dividends in terms of risk stability for fixed income investment? How can we compare this with the arbitrage fund holdings as part of the fixed income? I have no clue, honestly. I don't know the answer to this question. I don't look at power transmission InvITs. Neither do I look at arbitrage funds. I am a very strong believer of keeping things simple. So I believe that if I have to invest, I will invest in equities. If I have to keep my money aside, I will put it either in liquid funds or in fixed income. And in fixed income, either bank fixed deposits, spread it out into 2-3 banks, preferably the large ones, or I will put my money in gilt mutual funds or good quality debt mutual funds. As simple as that. Simple mutual funds. I don't try to make things so complicated, because end of the day, my yield from these is going to be between 5, 6, 7%. So I am not. So my objective of going to fixed income is not to reach for yield, because it is safety. I want to make my money in equities. The money that I don't want in equities, I want to keep it safe. So for me, that is a very clear thought process. So I am not interested to make life so complicated. Next question is from Anand Mehta. Say, if you have 2 stocks which you like, how do you choose where you recommend it in your advisory versus PMS? Depends on a lot of factors, depends on liquidity. See, in the PMS, the advantage is that we have discretion over the buying process and the selling process. So we can keep slowly buying, selling, etc. We can buy in bulk, we can buy in block deals, etc. So that is the advantage that we have. That is a disadvantage in advisories, because email is going out to a large number of people at the same time. I have no idea how much money each of them are putting in each stock, and how much of their buying is going to lift up or sort of disturb the price mechanism. So in advisory, a large, it's usually very liquid companies, or stocks where I think the longer term prospect is pretty sound, and where you can have people who will sort of who can buy at one point in time. So there's no fixed formula of which goes where, but it's more a function of our ability to buy and sell. So that's the way it is. Anand Mehta, are you concerned that as soon as the market environment gets better, there's a flurry of IPOs, PE exits, promoter sales gather huge momentum? What is your view on too much liquidity, choosing too few good growth stocks, leading to sharp expansion? I think this is going to remain a problem. I am obviously very worried. I'm more worried when I'll not say worried, but I'm concerned that at every rise in price, you have promoters coming and dumping their shares. Sometimes even the intent of the promoter looks questionable. Continuous capital raises, continuous dilution of equity, etc. But I mean, that's the nature of the markets. We are participants in the market. We cannot wish it away. We'll have to sort of take all that information and make it part of our process. And uh, you are right that there is this problem of too much money uh, chasing a few good stocks. But what can we do about it? That's the way it is. And with more and more passive investing, fund ETF based, index based, uh, how does an index fund operate? I mean, if a stock is in an index, people are just blindly buying it, right? And it's a very bad situation to be in. There's no uh, sort of thought process, or there is no filtration that is happening uh, while a fund manager is buying this stock, simply because it is part of an index. So yeah, I mean, I agree with you. It is a matter of concern, but not something that we can do too much about. Uh, Next is from Ramnath Prabhu. Sir, follow-up questions. Also, does the computation of intrinsic value using DCF, etc., serve any purpose? When I started 15 years back, I experimented using Peter Lynch, blah, blah, blah. Are these teachings, in fact, relevant to them? So the principles are relevant. DCF, the concept that future cash flows discounted to today's price is the intrinsic value. Yes, that is relevant. The exact calculation requires a lot of assumptions, and that is what makes it very, very questionable, because the assumptions that one makes is going to change the intrinsic value calculation dramatically, so much so that it becomes completely irrelevant from a practical standpoint, right? Uh, Peter Lynch, Graham, etc. I mean, like I said, everyone. So Peter Lynch is primarily a growth factor investor. Graham is a Graham's teachings is a value factor investor. His personal investing was growth, because his entire life's money he made in only one stock, which is Geico. And that is why I have this pet peeve about people who are teachers slash consultants. Most of them are good teachers slash consultants. They're not good practitioners. And although it is sacrilegious to say it, Graham is one of them. He's a great teacher uh, and a pretty poor practitioner, in my opinion, because the only stock where he made real good money is Geico, and that was also luck to a large degree. And he did not do well at all in any of the other, of his in nearly all other holdings. He did not do well. But I mean, this is not about Graham. His principles in terms of valuations or looking at low value, etc. So, see, what happens is any edge in the market over a period of time is going to get arbitraged away, right? So, if you think that I have got this, great magic formula and it is going to make me a billionaire over the next 100 years, it is not going to happen, because somewhere somebody is going to come and crack it. You get some of the best brains in the world coming into the markets, because markets deal with money, and this is one place where unbelievable wealth has been created historically and will continue to get created. And so you can have literally quote unquote rocket scientists leaving their jobs and joining the markets, trying to outsmart you. And so there is going to be no edge which is going to perpetually remain, right? So, and the other thing that is happening over the last 2 decades at least is that the democratization of information and the speed at which the information dissemination is happening has completely changed with internet, with mobile phones, with social media, with Twitter, YouTube, Telegram, blah, blah, blah. So today, if you look at, Twitter, for example, because I am active on Twitter. Uh, Everybody, if you type a stock code or a stock name, you will find at least 50 different people posting different technical charts, breakouts, ye wo. You know, सबको सब कुछ पता है. The point is, how many people are really making a lot of money? Because making money over a long period of time is just not identifying a stock. It is about how much you buy, how you buy, how you scale up your position, how do you handle times when things are not going well, right? Both for the market as well as for the company that you're holding. What are your strategies? Are you, technical trader? Are you a techno funda? Are you doing quant? Are you doing pure fundamentals? Are you value? Are you growth? Are you, what kind? So, I mean, to just summarize, I think principles are going to be valid. The implementation, the execution, the timeliness, all of that will keep changing, right? So, as investors, we will also have to keep evolving. So, if I look at myself, I have been doing this for 25 years now. I started in the year 2000. Complete Buffett follower for the first 10 years. Slowly moved on to, more of growth, GAR kind of methodology. Then moved on to uh, momentum, quant, technicals, techno funda, right? Now experimenting with machine learning, forecasting models, data-based insights. So, as an individual, I have also evolved. When I started, zero knowledge about behavioral finance. Now, I would say I'm a reasonably good student. Maybe class 8, 9 in that domain. So you have to also keep learning, keep updating yourself, keep uh, you know keep renewing your edge, finding out new edges. Okay, lot of gyan ho gaya. Next is Rajarshi. Your view on the power and transmission sector, is this due to domestic consumption due to AI for data centers? So I think India, it's not only about AI. AI obviously is going to play a part, data centers is going to play a part, but any developing nation which goes up the GDP curve, the first 2-3 consumption items is proteins in terms of food and power. So first thing that people do when they get more money is eat better. The second thing that they do is start consuming more power, right? So even we are seeing this in rural households. People start with light, then they get a fan, they get etc. etc. So that's how it is. So yes, I mean, the overall power transmission, distribution, etc., is going to pick up. It's already picked up. It's going to do well. These are long gestation projects, very cyclical industries in the sense that this will happen in tranches of a few years, every few decades. We are also in the process of migrating a lot to renewables, whether it is solar, wind, hydel. So again, those will continue, and aggregate power consumption is going to go up. So overall, I think it's positive for the industry. The next is from Nilabro. While sharing the quarterly results review, possible to make a video and touch upon the key points along with the mailer? I don't know. I'll tell you the reasons why I don't do a lot of videos. First of all, it takes me a lot of time. I was doing this monthly videos. Sometimes that also falls off the wagon, uh, because I am probably not a, quote unquote influencer, trying to do YouTube videos. Uh, so I don't have a setup. I don't have. I have uh, a laptop, and I have this old trusty earphone, and that's pretty much it. I have a decent microphone also. Uh, Video, I don't know editing. I all of that. I mean, so it's a headache. Can we do videos? I don't know. I mean, I can give it a shot, but don't bank on it. Uh, Personally, we are actually hiring more analysts and people who work with these things. So I don't know whether it will get better in the future. I hope so. But this is something I'll keep in my mind, but I cannot, no promises. Varun, what do you suggest for newly joined subscriber deployment of capital stocks that already ran significantly? This create a lot of confusion. Lot of times it happens that after you buy stock may go in sell basket. Yeah, I think I answered this question. Uh, it makes no difference. I mean, it might give you a mental disturbance for the initial few months, because you when you're coming in, you have a backlog of stocks that you have to buy. Once you buy it, first few months there might be some churn. Just follow it. After a few months, it will be, you will be in with the flow. So it makes no difference. So uh, the other point about stocks running up and buying, uh, makes no difference, because most of the time a stock which is going to go from 100 to 1000 is going to go to 200 first, right? So uh, sometimes, we've had stocks which have gone up tenfold, right? Or more, in fact. So stocks running up is normal. Don't have to be worried about it. Uh, and if there is a sell after a buy, just sell. It's as simple as that. Worst case is you lose a little bit of money in that transaction, but always remember that this is a process. See, always remember that when I'm asking some, we are suggesting a sell, it means two things. Either there is a problem with that individual stock, or we want to switch to a better stock, because capital is limited, right? So the idea is that not that I am making a loss here or I'm making a profit here, should I buy the other one, etc. The idea is that from today onwards to the future, the probability of the stock that we are selling is worse than the probability of the stock that we are buying in terms of performance. That is the why we are making that switch. So, look at it in those simple terms. The next question is from Anand Mehta. What has been your learning of few underperformers that we had before the portfolio refresh that we did around March? I think, underperformers don't really teach you a lot, honestly, because when you are buying something, you typically expect that the thesis that you have will play out. Now you know that in some cases the thesis will not play out and the stock will not perform. That is normal. The other way is only to buy stocks where you know it will perform, and you just buy those. But then the problem is, then the CAGR return reduces because you are not taking optimum risk. You also want to have some stocks which will not play out, because that means you're taking a chance in something where there is a probabilistic approach. So that's the way I look at it. There will be cases where the thesis will not play out. Now individually we'll have to go and figure out that, okay, apna ye thesis tha, why did not play out, what went wrong. Those things we do separately. But in terms of aggregate, right, there is always going to happen that not 100% of the stocks that you will buy will work out. I mean, uh, it's a popular saying that 6 out of 10 stocks work even for the greatest of investors, and I don't claim to be the greatest. So, for me, maybe 5 out of 10 will work. That's the way I look at it. I've been lucky that the percentage has been higher over the years, but that's the way it is. Next question is from Sunil. What is the expectation from rare earth minerals over the next 5 years? I don't have any expectations. In India, there are hardly any real players who are doing anything more than lip service. A lot of companies have PPTs saying we are doing this, that, or the other. I haven't seen any concrete work happening in rare earth metals anywhere in any company. If you know of anything, do let me know, but I haven't found anything. Raj, will this recorded video be available soon? I cannot guarantee. We'll try to make it available, but we'll see. I mean, again, I'll have to pass it on to a team member who will try and do that. I'm getting lazy and overworked both at the same time. Next is the question from Ramdev Sivakumar. Sting the long-term recommended at 15% cash. Yeah, you're right. I mean, we just addressed this question that we will be recommending few more stocks in the near future. The team has been working on it, and let's see. Next question is from Abhishek. Role of AI in finance industry, how will it impact the jobs? How one should prepare who's looking to get into job in this industry? See, AI is going to be a game changer, not only for finance, but for everything. My sense is that it is going to be like the computerization era. So, people who are there before the computer era, I mean, I was in school when computer came, so I am not really from the era before computers. So people who are, maybe 60, 65 plus are people who were in the workforce maybe when computers were not there. The shift that computers coming in had, I think AI is going to have a similar kind of shift, because what is happening is there are multiple things which are, again, the Lollapalooza kind of thing is happening. One is your ability to interact with a computer system is changing. Previously, interaction with a computer meant that you have to type in a specific way, you have to do it in a specific way. So, for example, let's say Excel. Knowing Excel well used to be a superpower in corporate. Already there are startups, I'm sure Microsoft will do it, but very quickly, I am sure we will see spreadsheets being made with just prompts, right? You don't need to remember any formulas, anything. You can just write and say, I want a pivot table of this, and this. And the pivot table will be made by Excel, right? So it's a game changer for people who had put in a lot of effort learning Excel. So there are two parts. One is what will happen to the people who already are in the workforce. Second is people who are getting into the workforce or who are already there. How do we, equip ourselves? One is, obviously, we need to keep ourselves updated, keep using, LLMs, all of them, whatever you get. I mean, the free versions we have. I personally, I'll tell you, I use Gemini Plus, I use Chat GPT, I use Perplexity, I use DeepSeek. Wherever, there is AI, I use Notebook LM. So, and I'm using them today pretty much every day. So you have to integrate your workflow, your learning process, your work process with these LLMs so that you also get used to it. That's number one. Second is the AI systems will get better. So today you find a lot of people spending a lot of time giving a lot of gyan on prompt engineering, that is going to be superfluous in 6 months, because the prompts, the AI, the system will learn to prompt itself better, right? So the thing that we need, and unfortunately, this is the part where the Indian education system fails miserably, is we have to be able to be very, very strong in concepts and in questions. How to frame questions, what type of questions. We have to be more and more curious about the world, about integrating different information streams. Because information per se is going to get commoditized. It is already commoditized. It's going to get more so. If you think about it, Google may, you had to put in a query, and the collation you had to do today, that is also being done by somebody else. ChatGPT is doing it for you. So the information collation part is also not going to be done by you. So what is it that you will do? You will have to ask better questions. You will have to think about 10 different angles of addressing a problem. So that is where AI is going to be helpful. But finally, having said all of that, AI is going to remain a tool. AI is not going to come and do your job. AI is not going to come and tell you that Abhishek, these are the top 10 stocks that you should buy. That you have to do. So at least not in the near future, AI is not going to tell you. But our job is to continuously keep learning, integrating our knowledge, integrating what we know now with what new information, what new things that are coming up, and integrate it into our processes and uh, work with that. Okay, 11:20. I think we've nearly completed 1 hour 40 minutes. We started 10 minutes late. I think this was good. Thank you all for joining, and let's call it a day. I'll stop the recording here, and we will